Good morning, everyone. So our topic of discussion today is quite a contentious one, very interesting one, I believe. And I believe that it will require some kind of engagement from our peers in the audience. So therefore, I'd like to do things slightly differently, where I will, from time to time, invite the audience to ask questions as well as voice their comments or opinions during the panel discussion. And I hope that's okay with the program managers. So I'd like to introduce the topic, and the topic centered around engineering East Africa's housing scale-up, where we look beyond the bricks and mortar and focus on how the various forms of capital actually are turning or addressing rather the housing deficit into a multi-million-dollar asset class. So before I progress, I'd like my panelists to introduce themselves just for 1 minute, and then we can kick off 1 minute each. Yeah. We'll start with you, James.
Great. Hi, everyone. So my name is James Maclean. I'm the Director of Real Estate at Fusion Group. Fusion Group, we're a mid-cap private equity firm with in-house development capabilities. And we've been investing, across the spectrum. So for the last last 16 years in real estate, and done, fully agnostic. In housing, we are, for the last 6-7 years, we've been looking at low-income rentals. I'm very much focused there, but recently turned our view back to kind of home ownership. And our view from the investment committee is that the solution at the moment for home ownership is self-build in East Africa. It's emerged because of the market, and we've set up Fusion Estates to focus and try and attract institutional capital to the self-build market. Hopefully we'll talk about it a bit more as we go along.
Good morning. My name is Esther Omulele. I'm the managing partner of MMC ASAFO. MMC ASAFO is a law firm which is headquartered here with a branch in Mombasa, but we're also part of a Pan-African law firm called ASAFO & Co., which has offices across different jurisdictions in Africa and out of Africa. So ASAFO's headquarters is in Paris, and in Africa, we have offices in Côte d'Ivoire, in Morocco, and a rep office in Johannesburg. So we've practiced real estate for 20 years. I can already see some of my clients in the room, and happy to be here. Thank you.
Good morning, me again, Sam Kariuki. I lead the park at Mivida Homes. Mivida was incubated, founded by Actis, so thank you very much, Ravi. In the last 8 or so years, and last year we had what I would call a successful exit transaction, which validated that initial investment thesis. We focus primarily on affordable and mid-market green-rated housing. Opportunistically, we may look at high-end housing like we are now doing at Tatu City. Primarily, we like developments in large planned mixed-use development, so we come in as an infill residential. So it's not surprising then that our primary development is at Garden City, and that is what has informed our foray recently into Tatu City. So far, we've been build to sell. We sell, then we build. But this particular year, we are now exploring and are at advanced stages of incubating a rental platform that will serve as an offtake, stabilization, and then forward selling entity for Mivida Homes. Thank you, and looking forward to the discussion here.
Good morning, everyone. I'm Preston Mendenhall. I'm the Group COO of Rendeavour. Rendeavour is the owner and developer of Tatu City. We have large-scale new city developments in Kenya, Ghana, Nigeria, Zambia, and DRC. The land that we own and develop is in the growth paths of large cities in these areas. So as Tatu is the example, is 24 kilometers from here, a decentralized environment with all of its own infrastructure and a real separate ecosystem that at the same time is very interconnected with the areas around it. Thank you very much.
Yeah, I think to jump into it, I think if I recall correctly, about 10 years ago, I sat in this conference where the housing deficit was a very topical issue. And I've come to realize that over the years, there have been those who actually sort of cry about the unavailability or lack of liquidity to actually execute or address the deficit. And there are those that have been actually very instrumental in addressing, in trying to rather address the housing deficit. So I'll ask this question, and perhaps maybe I'll start with yourself, James, on the other side, and then we'll come to you, Sam. And that is like, have you seen a shift really in the availability of appetite for housing developments in the region? And what changes do you believe are still needed to meaningfully address the gap and convert this sort of conundrum into some kind of multi-million-dollar asset class?
Yeah, sure. So it's very funny to answer that question following the panel before. But to speak from our experience first, so our capital historically was ultra-high net worth and emerging market funds out of Europe investing into this market. They put money in through us. And I can pretty safely say that's pretty much dried up from our point of view. The appetite's not there. I think 7 years ago when we were raising, everyone was saying, why would we invest in East Africa when we can do Eastern Europe and get similar returns? That didn't work out very well. And I think a lot of the capital has been sucked out of that market because of that. On the flip side, though, I think what we've seen recently, and when I mean recently, I mean the last 12 months, is the bank capital is back. We're getting people turn up at our offices wanting to lend, which hasn't happened in a very long time, which is great. And then, following on from the panel before, we're now trying to gear ourselves up for exactly as they covered. In the institutional capital here, which is the capital that understands the market best, has not been looking to invest in developers like us. And I get it, right? Why take development risk when you can get 18% playing the money market? So that money is coming back, as they said. And I think for us, we're very excited that money's coming back because it's such an easier pitch to someone who understands the local market to get that money. Whereas when we're pitching, even I think someone on the panel talked about going to the Middle East, there's still so much explaining of how our market works that you get bogged down in that. So for us, the key change that we want to see is that local capital flowing back to professional, well-governed developers. And if they really do that, that's the next growth spurt for our market, I think.
Thanks, James. Sam, from your perspective, would you like to add on to that in terms of, have you, in your investment platform or vehicle, been able to attract that local capital, having achieved and made so many strides from your product offering and just continue to develop at some kind of scale? What would you have to add to that?
Thanks for that. I think my view is that there's no lack of interest. There's no lack of investment interest. What possibly has lacked, especially in residential, is investment grade, well-structured, well-governed, executable investments. And I suppose, if you look at the history of residential in Kenya, it's been a highly fragmented market historically. It's only recently we've started seeing the emergence of platforms, platforms that can be scaled, platforms that over time have de-risked into investment grade assets. To the extent that we've seen some global capital, either incubating or acquiring residential platforms in Kenya, I suppose it does speak to my comment that there is, as long as there's an investable or an executable investment, there will always be interest. And I suppose if you broaden the definition of housing to include student housing, I suppose the experience of Acorn in a way does validate that. Our own experience, as Mivida, where we were incubated, by global capital, into a platform that could then be exited. It did demonstrate that in this kind of market, you can create those kind of platforms, and that eventually there can be, some liquidity paths to that. It's still nascent. I appreciate we still don't have many platform, what I'd call platform entities. We are only a handful. I wouldn't probably name more than 10 developers that I would call, institutional platforms. It's nascent, but I'm positive that it's growing. Over time, we are seeing a lot of developers moving from, single development into some form of platform play. But I suppose it's a challenge, especially for local institutional capital. We do have some structural challenges, I suppose, in the economy that have not made it easy for us to look for capital in the local market specifically. But I'm very positive. I'm positive as we now demonstrate through the kind of deals I spoke about earlier that indeed even residential itself does have investment grade type assets.
Sure, thanks. I'll jump on over to you, Preston. I mean, your product offering is slightly or completely different from, that of Sam's offering, and the kind of capital that you attract in terms of your development. Could you tell us more around that, in terms of the ease of raising, capital and the and in your capital stack? Essentially, I know Rendeavour uses their own equity to develop, and then they rely on, diaspora capital actually flowing in for sales.
Yes, we have a group of core shareholders from the US, UK, New Zealand, and Norway. We're a private company and we have no third-party debt. And we have had to take a very long view on our investments in Africa. Esther, who's been with us from the beginning, remember our launch of Tattoo City in 2010, and people asked us, how long does it take to build a new city in Africa? And very confidently, and I'd say somewhat arrogantly, we said 10 to 15 years. We're 15 years into it already, and now when people ask the same question, we say 50 years. It's a very, very long-term endeavor. It is dependent on the market, it's dependent on capital flows, but in terms of how we gear ourselves and engineer our financing, we're fortunate with our shareholders. It's essentially permanent capital, family office money, no private equity or institutional investors, and that means that we're able to continue to development whatever happens in the market in various ups and downs. So we do have our own development. So for example, we, in addition to doing all the infrastructure and master planning and development of Tattoo City, we have, I would say, complementary housing developments to what Mivida is doing at Tattoo City. So we have high-rise residential and mid-income G+4 apartments that we develop, about 1,000 units. And for some of those at a later stage, we might go and get some debt financing just for those individual projects. But across the group, in order to keep the development secure, we just look internally and rely on our cash flow and investors.
Sure, thank you so much. I think I'll jump back to we keep on referring to the term structural reforms and structural issues around the supply of housing and addressing the housing issue in the region. Sam, when we speak about that, are we seeing some kind of, there has been some kind of mitigations that are provided by institutional investors, such as your KMRC, KMRC providing some kind of relief to, your retail clients. Has that sort of created some kind of impetus on your end in terms of demand and the affordability for the housing products that you offer?
I would say it's sort of mixed. And before I give some detail to that, if you look at KMRC's balance sheet today, you will notice, at least the last time I looked at it, I think more than 50% of the capital they've raised is still held in government securities or in cash, despite them somehow being able to offer indirectly sub 10% or single-digit mortgages. And the question is why? Why would there be a 9% mortgage, but people are not necessarily rushing to take it? I suppose when we talk of structural deficit, it's a cliche word, right? But in our own experience, it's a reality in the market. It's if you look at this city, for example, it's growing by almost 200,000 people per year, which creates a primary deficit. But if you look at the character of residential development in the last 20 or so years, it has created what I would also call a structural deficit, the need for people to move from not so well planned current development into better planned quality rental. So you have a primary deficit and a secondary deficit. So that in my view, the deficit is real, and the demand there will remain long-term and very deep. The question is, what is the character of that demand? And the reality of it is that this city and probably the wider regional cities have a need for good quality rentals. So the demand driver is good quality rental and affordable for that matter. And therefore, the type of buyer today, the typical buyer today is an investor buyer. It's Lunga, myself, Preston, buying a housing unit to rent out because of the underlying rental demand. And in a way that then explains what I would call relatively low offtake of the KMRC type mortgages. In fact, we like to joke that our competitor in our space is not necessarily the next developer, but the money market funds, the Sanlam also money market funds, because real estate investment is typically an allocation by an investor from their savings or from a money market fund into a different asset class, but with the same sort of objective of a yield. So in a way, I suppose it's the character of the demand, the real underlying demand, that then plays out as to the type of investor and to the type of capital then that plays in both the demand and the supply side.
Thank you, Sam. Esther, I'll jump over to you. When we actually look at the structural deficiencies and trying to develop or put together these structures or investment products that are bankable and viable from a legal standpoint, what would be your view in terms of trying to de-risk these projects as best as possible and making them bankable for various institutional investors?
So it really starts with a recognition that the housing projects are long-term. Large housing projects are long-term. It's not short-term. So however you structure the project in terms of what you promise as a return to your investors, need to have that, recognize that in mind. Typically, projects take large projects, 5 to 10 years, or some even longer. Preston has just mentioned how long some of these projects ordinarily take. So based on that, when you're structuring products, such as, say, if you're structuring a bond, for example, it ought to be long enough so that you have sufficient time to do all the prep work, the construction itself, and then get to the selling bit of it. So have that in mind while structuring, and ensure that then your investors have patient capital. They have to be prepared to wait the time it takes for the title deeding to be done, for the construction to be done, for procurement to be done, identification of buyers to be done. All of that has to be taken into mind in structuring, investment products.
Sure, thanks. I think there's one thing, one key element that would impact the deliverance of these housing solutions on a scales perspective, and there's a levy that I've read about, and I think we've touched on it previously in our discussions. Could you talk more to that, and perhaps how that would in fact impact the product offerings of my clients, of my colleagues here sitting on the stage?
Yeah, so 2024, government introduced what we call the Affordable Housing Levy, which is a 1.5% of the earnings of every employee, with the employer required to, match that on a monthly basis. So that levy then goes into a fund, and its purpose is really to fund affordable housing. So the question has been, how do we link that fund to private investors? Is it only available to government, or is it also available to private developers? So when you look at the definition of what affordable housing units means under the relevant law, you find that it's in 4 categories. There's social housing, for one, which is targeted to persons earning less than 20,000 shillings. Then there's affordable housing units targeted to people earning 20,000 to 150,000. Then there's affordable middle income housing, which is where a lot of the private developers fall, people earning over 150,000 shillings. So when you look at that range, therefore you then ask, how do we then get that funding from the Affordable Housing Fund? So the Affordable Housing Board is mandated to offtake projects, right, from private developers. And the way it works is the private developer would have to have the project approved by the board. Following the approval, they would then need to enter into an offtake agreement with the board. And on the back of that, there would be an intermediary, an entity authorized by the capital markets that is then funded so as to offtake the project. So that's a process. Now, this, and the offtake comes, of course, on completion of all the units. So there's still the question of how do you fund from commencement, the planning, the procurement, the construction, how do you get to the point where your offtake is guaranteed? But the fact that it's guaranteed also means that it's, if you're looking for other investors, it becomes more attractive because there's an end in sight. So when the offtake happens, then these institutions that are permitted to offtake by way of the Affordable Housing Fund, they are then required to, they have access to what we call the Boma Yangu platform, where we have interested buyers listed and they can match the buyers and, do the sales or either do it by way of tenant purchase schemes. Yeah.
All right, thank you so much.
And just to mention on that, because Esther raises an interesting point. Unfortunately, the program has been very contractor-led rather than developer-led. And what the Kenya Properties Developers Association, jointly with Kenya National Chamber of Commerce and Industry, has done is to form a consortia, because we have a lot of developer members in both associations, to form a consortium that has then approached the Affordable Housing Board and made a proposal for an offtake framework, because at least the law does allow, I'm not sure about the regulations. And so currently, potential, yes. Hopefully there's nobody from affordable housing who is switching off my microphone. So, so we are working on a potential framework that would allow then we as developers, as a consortia, to have a framework that they can offtake, and hopefully that they can then fund through construction, which would address that issue of cost of funds. And the tension there, one is about the milestone-based payments, if that is possible or allowable by the law, but also the tension around the price point on a per square meter. Because they've been very contractor-led, the idea of the price per square meter is based off a construction cost per square meter and not a total development cost plus a margin, as typical developers would do. But it's something we are looking at.
Thank you, Sam. I think one key question, a very important question is, having the various capital instruments in mind, how important is it to, align the business models of yourselves as developers and, with that of institutional investor mandates, as well as the behavioral patterns of investors? How important is it that your organization, or any organization for that matter, operating in this space is aligned or matched with the right kind of capital? That's for you. Actually, it's for you, and then I think James could then chime in there. It's very important.
Oh, okay.
Yeah.
I would say obviously very important to align. And I suppose it depends on what kind of capital you're looking at. Is it on the supply side? Is it on the demand side? So if I give an example, as I mentioned earlier, because of the thesis around where the demand is on the rental side, where we feel is more of a need in the market, at the moment, Mivida is incorporating or incubating a rental platform And it would mean, whereas that is more of a demand side sort of solution, it means we are talking to aligned investors with a mid to long-term outlook and who, in a way, have the similar thesis around the underlying demand for rental. And as even the other panelist spoke to, I suppose it just comes to investability. Investability then means you're fully aligned with the mandate of the would-be investors. Yeah.
Thanks. James, anything to...
Yeah, I mean, it's quite funny because I've stopped going to our low-income rental monthly updates because it's always 98% occupied. It's incredible. And then I went to the market to try and raise 3 years ago for low-income rentals. And okay, maybe we should go back now that rates have come down. Not a nibble. And we are, I'd like to believe we're institutional grade, right? We're properly governed, we're regulated, we've been doing this, we've got a proper track record, but we couldn't raise that capital. Maybe we can now. But I think that's our main job. As a mix between a fund manager and private equity, our main job is matching where we know we can make money with what investors want.
Of one-stop shop for, like local businesses trying to establish themselves in Tatu City. How has it worked out for yourselves in terms of development?
Thank you. Yes, the one-stop shop, and actually the one-stop shop is part of the special economic zones at Tatu City. But overall, the framework that we've created is a special planning area. So that means that the planning approvals at Tatu City are fast-tracked at national level, the Ministry of Lands and Physical Planning. And this creates a high degree of certainty for an investors coming in that they're not going to get stuck. Their capital's not going to get stuck. Between the special economic zone and the special planning area framework, we can do approvals through the ministry. We set a record with Hewatele, you might know, which is a medical oxygen producer that's set up at Tatu City. 24 days, they got their planning approvals. So first we take them through our own development control company and make sure that they will meet all the national guidelines, and we take it for national approval. For other buildings, it's generally under 45 days. Mivida will be going through this soon with its development, and we've already had, even prior to the completion and announcement of the purchase of the land, very deep integration between the teams on the development controls, so we know that the design is fully compliant and it will sail through. So creating that kind of surety for investors is what we provide at Tatu City.
Sure. Thank you so much. I thought we would have time for questions. However, I can see that our timer has given us 30 seconds. So I'll just